Next problem. Problem number 17. Mr. X submits the details of the asset sold for the year ending 31st March 2019. First one, shares unlisted. See here, they have given the shares unlisted. So whenever in the problem, if they given the listed shares, that asset or that shares will not be treated as a capital asset because already the shares which has been listed in the stock exchange, they are supposed to pay the tax called as securities transaction tax. And if in the problem, if they mention the word for shares, then assume that it's an unlisted shares and calculate the capital gain. So here in the problem, they have clearly mentioned that the shares is an unlisted. So unlisted is nothing but the shares which is not yet listed in the stock exchange. So now they are not paying any tax called as security transaction tax, and we are supposed to calculate the income from capital gain. And purchased in April 2001 for rupees 54,000. Sold on 15/12/2018 for rupees 3,95,000. That is in the previous year. Second, on 1st April 2001, he agreed to sell jewelry to buy for rupees 2,70,000, which was purchased in 1976 for rupees 1,50,000. However, the sale could not be affected as Y backed out. Here, they have entered into agreement to sell the asset called as jewelry, that is between X and Y. But the Y has cancelled the agreement and he has already paid the advance amount of rupees 20,000 to X. But due to the cancellation of the agreement of the sale, the amount has been received in the form of advance is forfeited. Forfeited is nothing but it's a cancellation, which he received from Y. He now sold the jewelry on 15th July 2018 for rupees 33,10,000. So, and incurred rupees 20,000 incidental selling expenses on account of brokerage and commission. So, this 20,000 is the selling expenses or realization expenses. Debentures purchased in September 2018 for rupees 50,000, sold on 31st December 2018 for rupees 65,000. Next, sold his motor car purchased in August 2005 for rupees 1,50,000 on 15th March 2017 for rupees 1,60,000. So here, the motor car is a movable asset and it has been used for its personal purpose to any movable property except jewelry which is used for its personal use, then that will not be taken as or treated as capital asset as per the section 2 of 14. I'm repeating, any movable property except jewelry, if it is used for its personal use, then such asset will not be treated as an capital asset. Here, the motor car is not a capital asset. And the CI value for the relevant years is 1 and 2 financial year 100 rupees, 18 and 19 280 rupees. Calculate this capital gain for the assessment year 1920. So first go with the solution part. Assessing Mr. X status resident previous year 1819, assessment year 1920. Heading calculation of taxable income from capital gain. So first take the asset. So first asset is sold is shares unlisted. Shares unlisted. Now calculate the period of holding. The period of holding will be date of purchase and date of sale. So the date of purchase is 1st April 2001 and sold on 15/12/2018. To take the date, 1st April 2001 to 15/12/2018. It is the period of holding. And the asset is shares unlisted. It's an unlisted shares, which will be fall in the fourth category, that is unlisted shares, land or building. So the condition, if it is used for less than 2 years, it's a short-term capital asset, and if it is used for more than 2 years, it's a long-term capital asset. So since the asset has been used for more than 2 years, it will be treated as long-term capital asset. Calculate the income from capital gain. So first take the value called as gross sale consideration. So the gross sale consideration is rupees 3,95,000, which has been sold in the previous year. So value 3,95,000. From that, minus any realization expenses. So there is no any realization expenses for the asset is unlisted. So the balance amount 3,95,000 will be the net sale consideration. Now, from the net sale consideration minus index cost of acquisition, because it's a long-term capital asset. So the formula for calculating index cost of acquisition is cost of acquisition divided by PII of purchase year into PII of transfer year, that is sale year. So if the cost of acquisition, since the asset has been purchased from 1/4/2001, that is in the April 2001, so the purchase price will be the cost of acquisition. So the cost of or the purchase price is 54,000. It will be 54,000 as the cost of acquisition divided by the CII of purchase year. Since it has been purchased in the base year, that is 1/4/2001, so the CII value will be 100 into CII of transfer year. The asset has been sold in the previous year 18 and 19. So CII value of previous year is 280 rupees. So the index cost of acquisition will be 1,51,200. Next, from that, claim any index cost of improvement. Index cost of improvement, there is no any additions in the problem for the unlisted shares. So no index cost of improvement will be calculated. So the balance amount will be 2,43,800 is the gross capital gain. And if any exemption is available, claim the exemption, but they are not given any information regarding the exemption. So the exemption amount will be nil. The balance, that is 2,43,800 is the taxable long-term capital gain. Next, we move on to second asset. So second asset type is, that is jewelry. So the asset is asset jewelry. Now calculate the period of holding. So purchase date and the sale date. The asset has been purchased on 1976. So take the 1976, 1976, 1976 to the date of sale. So the asset has been sold on the date called as 15th July 2018. Take the date of sale, that is 15th July 2018. Now calculate the income from capital gain. So first take the value, that is gross sale consideration. So the gross sale consideration is, you can see in the problem, the gross sale consideration of the jewelry is 33 lakh 10,000. So take the value, gross sale consideration is 33 lakh 10,000. From that, minus any realization expenses. If you observe the problem, they have given the realization expenses or the selling expenses on account of brokerage and commission. That is rupees 20,000 will be the realization expenses. It will be 20,000 as realization expenses or transfer expenses. Now, from that, minus the from the gross sale consideration minus the realization expenses, that is rupees 20,000, we get the balance called as 32 lakh 90,000. So balance is 32 lakh 90,000 will be the net sale consideration. And here the asset is long-term capital asset because which will fall under the category 3, that is other asset, and the condition is if it has been used for more than 3 years, it is long-term capital asset, and if it is used for less than 3 years, it's a short-term capital asset. Since the asset has been used for more than 3 years, it will be a long-term capital asset. Now, since it is a long-term capital asset, we need to calculate the index cost of acquisition. So the formula, cost of acquisition divided by CII of purchase year into CII of transfer year. So in this problem, if you observe, the asset has been sold in the earlier or they have made the agreement in the earlier. But after the cancellation of the agreement, he has been forfeited the amount of rupees 20,000. So in such a case, if any amount which has been received in the advance and if it is cancelled or if it is forfeited, I'm repeating, if any amount which has been received in advance and if it is cancelled or forfeited before 1/4/2014. I'm repeating, if any amount which has been received in advance and if it is forfeited or cancelled before 1/4/2014, then the forfeited amount has to be deducted from the cost of acquisition or the purchase price. I'm repeating, if any amount which has been received in the form of advance and if it is forfeited or cancelled before 1/4/2014, then such amount should be minus from the cost of acquisition. If any amount, advance amount received and forfeited after 1/4/2014, then such amount should not be deducted from the cost of acquisition. Okay, so here they have received the amount on the date called as 1st April 2001. So that is before 1/4/2014. So the forfeited amount should be deducted from the cost of acquisition. So first calculate the cost of acquisition since the asset has been purchased before 1/4/2001. So the cost of acquisition will be purchase price or fair market value as on 1/4/2001. But in this problem, they are not specifically mentioned the fair market value as on 1/4/2001. But if you observe the problem, on 1st April 2001, he agreed to sell the jewelry for rupees 2,70,000. Means on 1st April 2001, the fair market value of jewelry is rupees 2,70,000. Okay, so the cost of acquisition will be purchase price of rupees 1,50,000, 1,50,000, or fair market value as on 1/4/2000 is 1 is 2,70,000. Whichever is highest will be the cost of acquisition. So the highest value is 2,70,000. Now we need to minus the amount which has been received in the form of advance and has been cancelled because such advance amount has been forfeited before 1/4/2014. So I have taken the working note to the cost of acquisition, that is 1,50,000 or fair market value as on 1/4/2001, whichever is highest, 2,70,000. And from that, now I am minusing the advance money which has been received by the assessee, that is forfeited amount of rupees 20,000. Now the actual cost of acquisition is rupees 2,50,000. I'm repeating, any advance money received before 1/4/2001 for 2014, and if it is cancelled or forfeited, it has to be minus from the cost of acquisition. So the actual cost of acquisition for the jewelry is rupees 20,000. Balance is 2,50,000. Now the value 2,50,000 divided by purchase year, that is before 1/4/2001, it will be taken 100. Sold year, that is in the previous year, 280 rupees. So after calculating the value, it will get the amount of rupees 7 lakh. The next cost of acquisition is rupees 7 lakh. And they have not given any increment value or the additions information. It will be taken as nil, and the balance amount is rupees 25 lakh 90,000. This 25 lakh 90,000 will be called as gross capital gain. And from that, we need to claim any exemption amount. If you check the problem, there is no information or they have not purchased any additional asset, so it will be, or the exemption amount will be taken as nil. And the balance amount is 25 lakh 90,000 will be the taxable long-term capital gain from the jewelry. Next, we have the third type of asset called as debentures, which have been purchased in September 2018 for rupees 50,000 and sold on 31st December 2018. So take the asset as debentures. Asset debentures. Calculate the period of holding. The period of holding, the purchase date is September 2018 and end on sale, that is 31st December 2018. So debentures, it falls under the financial asset, and if you check, the asset has been used for less than 1 year, so it will be called as short-term capital asset. Okay, so calculate the income from capital gain. So first take the value called as gross sale consideration. So the gross sale consideration is the sale value of the asset, that is debenture has been sold for rupees 65,000. Cost of acquisition is rupees, or the purchase price is rupees 50,000. Sale price rupees 65,000. 65,000. From that minus realization expenses, no realization expenses. The balance will be 65,000. That is net sale consideration. I have already informed you that if in the problem, if they given the debentures, the index cost of acquisition will not be applicable or available for debentures, even if it is a long-term capital asset. I'm repeating, if in the problem, if they given the debenture as an asset, even if it is a long-term capital asset, index cost of acquisition will not be applicable for the debentures. Only the cost of acquisition should be deducted. So calculate or take the index for cost of acquisition. So the asset has been purchased after 1/4/2001. So the purchase price will be the cost of acquisition. So the purchase price is 50,000. Now, since they are not given the additions information to the balance amount is rupees 50,000, that is gross capital gain, and no information about the exemption, the balance amount rupees 50,000 will be the taxable short-term income. And last, we have the fourth asset, is sold is motor car. So I have already told, any movable property which has been used for its personal purpose, personal use, it is not a capital asset. So the asset called as motor car, motor car, fourth asset, motor car, which has been used for personal, it is not a capital asset. So the total income from the capital gain is from the debentures 15,000 rupees, from the jewelry 25,90,000 rupees, and from the unlisted shares the amount is rupees 24 lakh, 42 lakh, 43,800 rupees. I'm repeating again, if in case, if they given the information regarding the amount which has been forfeited. So the condition is that if any amount which has been received by the assessee in advance, and if it is forfeited or if it is cancelled before 1/4/2014, then the amount received in the advance has to be deducted from the cost of acquisition. And if any amount in the form of advance received by the assessee, and if it is forfeited by the assessee after 1/4/2014, then such advance amount will not be deducted from the cost of acquisition.